Was there something in CPI for everybody?
I think so. I mean, it's right in line. So if you're hawkish, you can take something away. If you're dovish, you can take something away. I think for the doves, the fact that housing was such a big component, and we know that real-time rental indicators are turning down, housing is set to slow. I think that's something to take away. Core services, housing, wasn't soft, but it wasn't too strong either, which is the Fed's kind of wage gauge. On the other side, goods inflation has been pretty stubborn, and it pushed CPI a little higher today. I think for people who are a little hawkish, for people who expect rates to stay high for longer, the fact that goods inflation might not be a zero forever going forward could be something that keeps the Fed a little bit more hawkish, more aggressive than people would like to see.
We're seeing futures lower across the board today, Zach. But yesterday, a mixed close on Wall Street. It almost as though the markets took this in its stride. Does Fed policy still matter at this point?
Well, Contessa, of course, Fed policy still matters, but I think the important thing for us as we look to this year is that just Fed policy matters a lot less now that policy is better balanced. They still have work to do, and certainly you've heard Chair Powell and others talking about that over the last few weeks. But we're just not in that situation where we're going to really get an edge by having a better understanding of the way the Fed is looking at things. So that was last year's trade. I think this year's trade is more about how the data evolve. And how that interplays with this idea of, we were focusing on growth we were focusing on inflation, and now we're focusing on growth. And now, and to Ross's point about something for everybody, we're kind of in that place where the market doesn't have any guidance on really what to focus on. And so I think that's where we are right now. We'll see how things play out, but that's how we're thinking about it right now.
If it's reaccelerating in the United States, where do you put the reopening in China? And both of you, I'd like to ask this question to. Where do you put the reopening in China in terms of fueling global growth? Zach?
Yeah, I mean, I think that's a bigger deal, actually, than a lot of investors realize. We've had, the second largest economy basically offline for the last 3 years. And so, seeing that roll through in the data, it's going to take a couple months for it to show up in actual economic data and then earnings data at the company by company level. But we do expect it to be something that's positive, for the Asia region directly and then more broadly for the globe. If that coincides with a stronger U.S. economy, which I do think we are in that position as well because of how strong the consumer is, that could set up some issues for the Fed down the line, but that's not something that we're worried about right here today.
Ross, what do you think? The China reopening has been, in some sectors, very strong. We've seen that in Macau with casinos and travel. It looks like we're seeing pent-up demand similar to what we've seen in the United States. But overall, perhaps more muted. Where do you place your investments where this reopening in China is concerned?
Right. I mean, I think that's exactly right. So you have a much larger consumer base, and you had a much longer and more stringent lockdown. So if you think about what the reopening was like in the U.S., and I think in a lot of ways we're still seeing the effects of that with services spending continuing to be really strong, the consumer sector continuing to spend. That's going to be kind of multiples of the effect in China, where again it's a bigger population and the lockdown was more stringent. So it will take time for that to play out. I think on the other side, the manufacturing sector there has been plagued by lockdowns and transportation issues, shutdowns at ports. That largely will be behind us as well. So as far as U.S. companies that have key supply chains and manufacturing there, I think that'll be a big benefit. On the other side, as was mentioned, the Fed, it will help reflate some commodities, things like oil, metals. So I think that could provide an issue for the Fed. But again, that's a longer term story, not as big a concern. And I think the global growth picture is brighter today because China reversed their COVID zero policy.
Let's talk about this recent rally we've seen. Zach, you say that you've got beaten down sectors, profitless tech, and the most shorted and volatile stocks leading the rally in a big way. Do you think it reverses then at this point?
Yeah, I think that's the common thought, right? People call this a junk rally, low quality. We agree with that assessment. What I don't necessarily draw the inference to is that means it's going to reverse. We are in that type of situation where having that really clear macro narrative that we had for all of last year is just not easy to come by at the moment. And so, in that case where the picture is a little muddier than it is normally, my bias is to look at things like positioning, flows, and sentiment. And what I see there is the market's pretty offsides, and is likely to fuel a continued rally. I mean, specifically and just, really short term here, I'll be very interested to see how the market reacts to a retail sales print this morning. We know that the consumer has been reaccelerating. We get a better, sales print, and, how stocks react to that, I think, could be very telling for how investors are thinking about the outlook in the really short term.
Are you positioning yourself in retail ahead of the earnings reports that we talked about just a little bit earlier? TJX, Walmart, Home Depot, among others.
We've pared back a lot of our defensive positioning within the U.S., but we're definitely not chasing this kind of low quality rally that we've seen. We do think valuations matter when interest rates are 5%. It's just a completely different environment than we've seen for the last 10 or so years. But we pared back some of those defensive positionings just in light of this fact that the dynamic that we were in last year just is not relevant. And so we're taking selective risk, across our portfolios. The main place we're doing that is internationally, though.
All right, Ross, you get the last word. How are you positioning yourself?
I think international is really interesting right now. You mentioned valuation in a higher interest rate environment. Europe still looks quite cheap, and they've avoided kind of the worst case scenario as far as an energy crisis. But I agree. I mean, this rally is better pricing a soft landing. We think that's the right call. But from here, upside is, we think, fairly limited in the near term because it's hard to see valuation expand a ton with, again, rates at 5% and the Fed wanting to go higher. So we like cyclicals. We like the things that would benefit from a soft landing. We think the economic picture is looking up, but maybe upside a little bit limited in the near term from here.